Okay, study objective 6. This is a fairly important study objective to look at too. We talked about the manufacturing overhead account a lot in this chapter so far. We've seen how if you look at a T account for overhead, the left side, or the actual overhead costs, the costs that were incurred by the company that had to get paid for, were all accumulated on the left side, of the debit side. We debited overhead whenever we credited accounts payable for repairs, or property tax payable, or accumulated depreciation for depreciation expense. All those costs got debited to overhead. And then, since we couldn't apply those costs directly to jobs, because we can't trace those costs to specific jobs, we had to apply some estimate of overhead to jobs through that overhead rate. And whenever we did that, we credited overhead to signify that we had, in fact, gotten some costs recorded into individual jobs, and we've got paid for those costs, so they're covered. But at the end of the year, we're going to have a difference here, because we can't possibly have exactly estimated our overhead costs for the year and exactly estimated our direct labor hours, which, by the way, labor hours, machine hours, sales, any number of factors can be used as the activity base. It doesn't have to be direct labor hours. But anyway, we've applied or allocated some of the costs to jobs, but we didn't get it right for sure, exactly right. So we're going to have an over or an under applied overhead situation at the end of every year, and we have to fix that. Basically, if we have applied too much cost to jobs, too much, our overhead rate was overstated unknowingly, and we put too much cost to jobs. Effectively, we've put too much into cost of goods sold, because too much went into WIP, and then too much went into finished goods, and then too much went into cost of goods sold. So our situation at the end of the year would be cost of goods sold being overstated, because it's not more than the actual went into cost of goods sold. So in that case, we would have to reduce our cost of goods sold balance. The inverse would be true if we didn't apply enough cost to jobs. In that case, we'd end up crediting overhead for a lot less, or at least less, than the actual amounts. So we'd end up with a debit balance in overhead at the end of the year. This signifies that we have under-applied our overhead for the year. And basically, all we have to do to fix that situation is just zero out the overhead account to cost of goods sold. So if we see that if there's a debit balance in overhead, we'll have to credit it to make it go to zero. If we credit overhead, that means we would have to debit cost of goods sold. And debiting cost of goods sold increases cost of goods sold, and that would be appropriate since we didn't apply enough of the actual costs into our cost of goods sold. And the inverse would also be true if we saw at the end of the year that we had a credit balance in overhead. That would mean the applied costs were too high. We would have overstated cost of goods sold, so we would have to debit overhead to make that account have a zero balance. And if you debit overhead, you'd then have to credit cost of goods sold. That would reduce cost of goods sold, which would be appropriate because cost of goods sold would have been overstated in the first place. Crediting it would reduce it. So you can see right here, if you read on, that you've got this situation here where you're debiting overhead in situations where you would have over applied. And let's see, I think no, it doesn't show you both scenarios, but the inverse is true if you under applied overhead. So you have to practice with that a little bit. You'll see it in a few of the problems as you move on through the homework.